Today, we're going to tackle something that gets right to the heart of the business world, but it's pretty misunderstood. What's an auditor supposed to do when they find out a company's been breaking the law? It's a huge question, and the answer? It's probably not what you think. It really all boils down to one simple analogy. Is an auditor a doctor or a detective?
So let's just jump right in with the big question, right? A company does something illegal. Maybe they're dumping toxic waste, maybe they're not paying their taxes, whatever it is. Is it the auditor's job, the person checking their financial books? Is it their job to catch them? This question really cuts to the core of what an audit is all about.
And to figure that out, we have to get a handle on what an auditor's fundamental role even is. The best way to think about it is with that analogy I mentioned. Are they a detective, magnifying glass out, actively hunting for crimes, or are they more like a doctor, just checking up on the company's financial health?
Okay, so the official term for this stuff in the audit world is non-compliance. And what I think is super interesting about this definition is the wording. Acts of omission or commission. That means it covers both the bad things a company did and the right things they failed to do. And get this, it doesn't even matter if they did it on purpose or if it was just a huge mistake. It's all non-compliance.
And here we go. The answer to our big question. An auditor is a doctor. Their main job is to give an opinion on the company's financial health. Are the numbers you're seeing legit? Are they presented fairly? They're looking for symptoms, things that make the financial reports sick. They are not detectives. They don't carry a badge, and they're not hired to run a full-blown criminal investigation into every corner of the business.
So, if the auditor isn't out there looking for every illegal act under the sun, which ones are they responsible for? This right here is where we get to the most important distinction in this entire explainer. The auditor's responsibility completely depends on the kind of trouble the company's gotten itself into.
Okay, this slide is the whole ballgame. Everything hinges on this distinction. On one side, you've got direct effect noncompliance. This is an illegal act that immediately and directly messes with the numbers in the financial statements. A perfect example is unpaid taxes. Boom, that creates a debt, a liability that isn't on the books. For these, the auditor absolutely must find them if they're big enough to matter. But on the other side, you've got indirect effect. This is a violation, like breaking an environmental law, that doesn't change the numbers, at least not yet. It could lead to a massive fine later on. For these, the auditor is not required to go searching for them. They just have to keep their eyes open for red flags. If you get this one concept, you've got the key to the whole thing.
Theory is great, but let's see how this actually plays out. We're going to take our new framework, direct versus indirect, and apply it to 3 common scenarios that an auditor could easily run into.
First up, a situation that's super common and really clear-cut. A company gets its payroll taxes wrong. Let's see what happens.
So here's the deal. The company took the money right out of its employees' paychecks. We're talking a whopping $1.2 million bucks. But then they just didn't send it to the government. This is a big deal. It means the company has a massive hidden debt to the government that isn't showing up anywhere in their financial records.
So, what's the verdict? This one's a slam dunk. It's a classic direct effect. The illegal act, not paying the taxes, instantly created a huge misstatement on the books. There's a $1.2 million liability that's just missing. Any standard audit test of payroll should catch this. The auditor is 100% expected to find this.
All right, now for case number 2, and this one looks totally different. This time, a company is breaking environmental laws.
So a company is illegally dumping chemical waste. That is definitely against the law, no question. But look at the key detail here. No fines have been issued yet. There's no bill, there's no court order. Right now, there isn't a specific dollar amount of a penalty that needs to be put on the books.
And because there's no financial event yet, this is an indirect effect. It's not the auditor's job to go out to the plant with a shovel and test the soil. No way. Their job is to ask management the tough questions, to read the minutes from board meetings, to look at letters from lawyers. If they see a red flag, like a scary letter from the EPA, then they have to dig into the potential financial fallout. But they aren't required to find the illegal dumping in the first place.
Okay, for our last scenario, let's look at something a little different. This isn't about breaking a government law, it's about breaking the rules of a private contract.
The company has a big bank loan, and it came with strings attached. One of those strings is a rule saying they have to keep their current ratio, which is just a quick financial health checkup, above 1.5. But, when the auditor runs the numbers, they find the ratio is only 1.2. Breaking this rule means the bank can call him up and say, "We want all of our money back now."
So is this a direct or indirect effect? It's another direct effect. But why? Because breaking that rule instantly changes how that debt has to be shown on the books. That loan isn't a long-term problem anymore. Suddenly, it's a short-term liability. Due right away. That's a massive change to the company's financial picture, and it's absolutely something a normal audit should catch.
So let's just pull this all together. This little summary makes the pattern perfectly clear. For the two direct effect cases, the taxes and the loan, the rule breaking immediately changed the numbers on the financial statements. The auditor's job? Find it. But for that indirect effect environmental problem, their role was just to stay alert for trouble, because the financial hit hadn't actually happened yet. See the pattern?
Okay, so we've nailed down what an auditor is supposed to find. But what happens next? Once they've flagged an issue, what do? Well, they have to sound the alarm, but the real question is, who do they call?
First things first, the auditor has to figure out how big of a deal this is. You can think of it like a 3-level scale. Down at the bottom, you've got clearly inconsequential. I mean, think it tiny $50 late fee. It's technically wrong, but who cares? In the middle is not trivial. It's more than nothing, maybe a late tax payment that came with a small penalty. And then at the top, you have material. These are the big ones. This is our $1.2 million payroll tax problem.
And that severity level dictates exactly who gets that phone call. If it's clearly inconsequential, no biggie. The auditor just makes a note in their files and moves on. If it's not trivial, they have to tell the company's management. But, and this is key, if the issue is material, that news has to go a step higher. It goes to management and to the people in charge of overseeing them, like the board of directors or the audit committee. It's a very clear chain of command.
All right, so all of this work, all the digging, the judging, the reporting, it all flows into one final, super important document, the audit opinion. You can basically think of this as the company's financial report card for the year. This table is the perfect cheat sheet for the 4 possible grades a company can get. If the non-compliance issue is small, they get an unmodified opinion. That's like getting an A+, a clean bill of health. If there's a serious material problem, but it's kind of contained to one area, they get a qualified opinion. Think of this as, everything looks great except for this one thing over here. Now, if the problem is so huge and so widespread that the whole financial report is basically useless, the auditor issues an adverse opinion. That's a failing grade, an F. And finally, if management just stonewalls the auditor and won't give them the info they need, the auditor issues a disclaimer. They basically throw their hands up and say, we couldn't get the evidence, so we can't even give you a grade.
And that really brings us to our final thought here. We have learned that a clean audit report is not a stamp of approval on a company's behavior. It is not a guarantee that they've followed every single law. So, what does it actually promise? It promises that an independent professional has checked the numbers and believes they paint a fair picture of the company's financial situation in all the ways that materially matter. It's a statement about financial truth, not about legal or moral purity. And understanding that one difference is the absolute key to understanding what an auditor really does.